Okay, the microphone's on. We did a nice little sound check. Good morning, good morning, good morning, everybody. What a difference a week makes. Boy, this is a wild world in which we live in. So, with that said, S&Ps. I don't know if everyone's been following the videos that we've tried to do, and I know last week we had one that as the fact that we were in Germany and could not get through a firewall for whatever reason, get it posted, but we tried to do it as soon as possible. In any event, when we take a look at this situation that we had, this little gap in here, that was from Lawrence Sumner's announcement. Market came up. We formed a low close doji in the E-mini S&Ps. Against this high, that's pretty much what we're supporting against. The overall equity markets, obviously with Ben Bernanke, fundamentalists, there's two sides of the coin. Hey, quantitative easing forever, and the other side of the coin is, but if it's quantitative easing forever, then how good can that be? How can the economy be all that great? And maybe the stock market's ahead of its time. Looking at the advanced decline, I mean, I'm not going to draw arrows. I'm just going to draw, I would like to just delete that, draw horizontal line so I get the exact numbers correct. So from last peak, you can tell that we have breached. So stocks did join this rally. It was a broad-based rally. We did take out the old highs, both in volume levels. We did take out the highs, so we had a confirmation that that is a if we line this up correctly to the old high, there we go. So from when we had the highest close in the market on August 2nd, we had new highs in the advanced decline. We had new highs on volume. Now, as the market kind of sold off during that time period, we had deterioration, and it came with volume, so it's good confirmation. And all of a sudden, we had an idea that if the market got above 48 or in the S&Ps, then we're no longer bearish to market, and we got that trigger right here on that daily buy signal. So at that point, we were bullish up to a certain point. Thought the market might fail up against this level here because the outlook, as you can see, the monthly pivot target resistance, we have a lower high and we have a lower low. So it's targeting a bearish, S&Ps had a bearish outlook for the month. We just went up and barreled to new highs, which is really bizarre, to barrel to new highs, but yet still be technically bearish the market. So that means that the market's probably at an unsustainable move here. Until we get a, and I guess we could trade the daily market off of a low close doji against monthly resistance, and that makes sense. And so for today, for intraday trading, and I'm sure Butch is a good game plan for that, the first part of resistance that for day traders, and I'll show that in just a little bit, pay attention to the 60-minute moving averages, and the 60-minute moving averages, falling fast at around 1703 and a quarter. You don't want to see the market get back above above 1708 in my books. That's for day trading, and just post that in. I'll go back to looking at the day trade setups or swing trade setups in just a minute. But as far as the market is concerned, if we take a look at the daily action and we look at the Russell real quick, well, we formed a doji on Thursday. We didn't make a low close doji on Friday. Today we will if we close down here. The advanced decline on the Russell shows a little, obviously, as you can see here, a little bit of bearish divergence. So we have bearish divergence there, but again, it's just the way the market has been behaving all year. It's kind of like one sector strong, one sector is weak. Advanced decline doesn't move, but it's on heavy volume. The advanced decline moves, but it's not on, or the volume moves, but the advanced decline doesn't. It's not been a market that's been in sync. It's been a difficult trade for a lot of people this year. Some people are just blindly bullish and they, buying breakouts, and it's been difficult. So in our stock picks for the year, we've done very well. Now it gets extremely challenging, and even for myself, I didn't see the Lawrence Sumners, and I didn't see this last blow-off top coming. But what I do see with the Fed is the fact that I did send an email alert out, and I did say, you know what, this market looks too strong. We probably could see a retest or see a test of 1727, and we did. So now what do we do from here? I think the old adage is trend consolidation. So the S&Ps do not demonstrate to me a massive decline forthwith. forthcoming. It's not Fort Worth, but forthcoming, I meant. What I think that any intra-week, like say today, tomorrow, Wednesday, any rally is a credit call spread opportunity in October, hands down. And you want to go with our option rules. You want to look for, you know, within, and this week I plan to be in the room actively with everybody and go through some trades with my own account. And so we're going to look to do that this week, not just for day trading, but also some swing and position trading. So with that said, this particular week, the reason I'm not looking for a massive erosion in price, because A, I don't have any backup supporting evidence that the market's going to crash in the Russell. I don't have any backup supporting evidence that the market's going to crash in the NASDAQ. And then the Dow, which has been weak all year, the high dividend yielding stocks, I mean, it just came to life. And then finally, this is the Dow futures, mind you, finally, and this is what I was just talking about, looking at the volume, we didn't break out of this trade with new volume, but you did break out marginally with the on-balance volume. We're above our on-balance volume moving averages, as you can see, and we're above the advanced decline moving averages, as you can see. Today, we'll form a daily sell signal. So, you know, just because the S&Ps, and this could be because it's weighted for end of quarter, and that's another issue that we had. It's end of quarter window adjustment. So this particular week, the NASDAQ is still strong, and you can see that on your charts, you know, for looking at the NASDAQ 100. And it's just been the one that's led the market up since mid-July or late June. So I come to looking at this and I say, gee, if I'm going to get a bearish again, I need to see, and at the time, as you can see here, at the time, back when the market had the doji here and we had a sell signal in the NASDAQ, boy, that whole deal in here is just very treacherous and tricky. It just shows you how difficult the market can be, and we do not have confirmation. So what's driving this market? Is it fueled by the Fed? It's fueled by global rise in equity markets. I was just in Germany, in Munich, and let me go over here and go to my spread page, by the way. Help me find it. Comp relative strengths. Okay, here we go. While I was over there, we saw a breakout in materials. We saw a breakout in industrials. Keep that in mind. It's very important. Industrials and materials had a breakout in the marketplace. As well, Germany, you see this black line right here? Germany broke out and made new yearly highs. France made new yearly highs, closing on a closing weekly basis. This is a weekly chart. Interesting, we just barely made in the S&P 500 a new yearly high on a closing basis. Barely. If you take a look at our closing price here, we closed at 15,658. We closed Friday at, so we closed at 15,658, and we closed here at, we didn't make a new closing high. I take that back. What was I thinking? 15, S&Ps and the Dow did not make new yearly closing highs. But we did in France, we did in Germany, we did in Italy. Excuse me? They're the ones that have the biggest problems of all, and yet their equity markets just rallied and made new yearly highs. Even though the S&Ps are outperforming, they're not outperforming as far as leadership right now. It's coming from Europe. So does that spell a weakening euro currency if their economies are improving and outperforming the U.S.? No. So the worst sector of all is this Latin America. It's way down here. It's negative 14%. Emerging markets, which would be Turkey. Emerging markets is India. Those markets are really sucking eggs, but they're coming back from the bottom. So the moral of the story is that, you know, rising tides lift all boats. All equity markets saw a lift in the last 2 weeks. And I'd have to say that when we take a look at what's going on in the world, energy prices in Europe, they're big on watching energy prices, especially Brent crude prices. We are very big on WTI, West Texas Intermediate. So when we take a look at this particular chart or this style of analysis, this is a crack spread. You know, you can just look at simple technical analysis, but the crack spread, looking at spread sometimes, that's why we look at the knob spread, which is notes over bonds. That's why we look at spread charts. It kind of gives us maybe an insider view if we don't see what really is going on in the market. When the crack spread goes down, it means when the spread narrows, goes down, okay, it means that the products, both reformulated blend gasoline and heating oil, are underperforming crude oil. Okay, they're all going down, but crude oil, you got to buy crude oil to make and break down these two different products. So when the crack spread goes up, it shows that crude oil goes up dramatically more, outperforms the byproducts. Does everyone see that? Everyone see that? Okay, so in essence, the indicator right now is starting to turn up. It's starting to turn up. Well, if crude oil, if these products in the next 2 days, and you see a break in the crack spread, so that's one thing we're going to watch this week, because seasonally speaking, this is the worst time of the year for crude oil prices. They typically go down. Why aren't they going down? Well, obviously there's trouble in the Middle East and with Syria and the pipelines, et cetera, et cetera. We got to keep our eye on that situation. But when we take a look at this range in the market, I've been saying for quite some time that this area, that low right there, was very important. This tweezer bottom right here, equal and opposite. Market went down next day. Notice that in this area here, and this will show up on anyone's candlestick charts on crude oil, the market had what we call the equal and opposite. It's a very bullish, it's a key reversal formation. So you had that, and then last but not least, you have this last quasi hammer, because it's not quite a hammer because the distance of the range of the shadow is not twice the distance of the open-close relationship of the real body. But nonetheless, everyone can kind of see that, man, from these 4 points of interest, there's just an enormous amount of, anyone can see this on their charts, and we all know that. But if we take out, if everyone that comes down here is a buyer, goes up, 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 what happens when they break that level? Here's what should happen. When you have that much time that has gone and supported a market, it's not going to just crap out. It's going to have an initial sell-off. In my experience, it'll have an initial sell-off, but what it should do is give you a little trigger to sell off, go under, hit some stops under the market. So that'll be your first level. We're breaking that now. Then you get under that tweezer bottom, which is a little bit safer. It's around 103.5. You get underneath that level. What we should see then, what we should see is a market coming back up to test the resistance. And if it fails, if it tests that resistance and fails, guess what? Old support becomes new resistance. What do we want to do in that case? Old support becomes new resistance. And let's get our chart one more time. Then we should go back down again. Okay? Anyway, we're going to be looking for, right now the market is in a negative dive right now. Everyone's got their eyes, and I mean everyone sees these. I'm not the only one that does chart analysis, but everyone can see that. And with the seasonal analysis, I tell you what, the fact that the crack spread has been down, I want to make sure that the crack spread breaks these lows. If the crack spread breaks these lows, that means that this is not just a quick down and then it's just trading at the bottom of the range. It means that crude oil is underperforming and there's real institutional selling going on in the market. Okay? So that's one of the things that we want to look for in this particular week, especially as it regards to crude oil. All right? Mike L says sell, sell, dive, dive. All right, so as far as the markets and looking at our what the performance of the market is, you know, bonds, notice this pink line, this fuchsia. It's the most obnoxious color, but it's bright, it's brilliant. Bonds are starting to come back since, and this goes back since August 23rd, and we can tighten this up anytime, but you know, first we got gold. Gold, they're dumping gold. We've got crude oil. We've got the Japanese yen and bonds. Many of you have heard me from time to time say, as go bonds, so does the yen, right? And I mean, seriously, look at the correlation, gray and fuchsia. It's not on top of each other, but the directional trend of the fuchsia and the gray, you know, gray up, fuchsia up, gray down, fuchsia down, gray up, fuchsia up. And you can see the correlation. Gray peaks and then moves lower, fuchsia peaks and goes lower. The correlation of the price direction of Japanese yen and bonds is very strong. How many times, hopefully you guys have heard me say this, I've said it for decades. It was something that was taught to me back in the 80s, because the Japanese were big buyers of U.S. securities, you know, our financial markets, our bond market. So it would be a very, you know, a tandem relationship, and it still exists to this day. And this relative strength analysis that I've created reflects that. So the euro currency is this green right here, and the euro currency, along with their equity markets, have seen a little breakout. I mean, that's not really moving. It's moved sideways. If you think about it, since the 18th, on the last couple of days, it's gone sideways. And the equity markets here, we have this dark green, which is the S&Ps. We have this blue, which is the pound, which really outperformed from a seasonal perspective. We have the Dow right there. We have black is the NASDAQ, and orange is the Russell. So our U.S. equity markets are really still outperforming. What we want to see happen is and then here's where the trouble exists, if we start to see the equity markets from a relative strength perspective move lower in concert, not just the S&Ps, in concert. We want to watch all of the equity markets in concert move lower, and if the bonds move higher, that means there is some I think, longer-term opportunities for selling and being very cautious in the market for the next 60 days. Until that happens, though, I think the equity markets, because we still have strength and leadership in the NASDAQ, that's where I say the market is due for a pause. And if the market's due for a pause, and you're just going to see that more of that same old sector rotational grind, you know, they come out of this, they go into that. Until we get, you know, more definitive analysis and trades that show the true direction of the market, this is probably a better time for just looking at credit call spreads in the S&Ps on any rally in the next couple days. And a rally, even today, if we get up to 3.5, 4, 5, an intraday pop in a rally, you know, 08, I think that's a safe area. Here is a look at our top sectors in the market that you need to focus in on. The first one is the Russell. The KRE is the regional banks. The spiders. XLB is the material sector. XLE is energy. XLF is financials. XLI is industrials. K is technology. P is staples. U is utilities. V is healthcare. Y, consumer discretionary stocks. All right. So with that said, when we take a look at the best and the worst, I mean, right here, utilities, hands down, is the worst so far. Consumer discretionary and regional banks, but regional banks have really come off their highs. They've really come out, and we go over to this area here, just to give you an idea. The two worst sectors in last week's performance was the banking, the BKX, the bank index, and the KRE, the regional banks. I mean, that's pretty bizarre that here the market was strong. The Federal Reserve is out there. He says, no, we're going to not taper. So interest rates are going to come back down. Banks profit less. Well, there's how that makes sense. If you're just looking and focusing in on the XLF financials, it was up marginally. Remember, part of the lesson is that we teach is that you've got to look at each individual ETF and see what they're comprised of. An ETF like the XLF is not a pure financial play and insinuating bonds. banks. It's a diversified financial ETF. It has American Express. It has an insurer like MetLife. It's got an exchange like the CME. It does have banks in there as well, but it's diversified financial. And so it's not going to give you the true health of the banking market. If the banking market weakens, you need transportation, you need the banking, and you need technology. You need all three sectors to boost that market. That's the Dow theory kind of thing, right? And right now, we don't have it. So with that said, when I look at this analysis and I go, wow, I'm putting everything together. What sectors do I really want to focus in on this week? What stocks do I want to focus in on? Consumer discretionary, it's coming up to the holidays. We talked about Coach last week. We talked about some of the retail apparels last week. And all in all, when we take a look at the various sectors, which I'm going to do in just 2 seconds of scanning for our stocks, I'd say when we come to consumer discretionary stocks and how the economy and the general public's doing, probably the most widespread best consumer discretionary measurement is Las Vegas. If you got so much cash that you pay your bills and everything's well, and you got enough cash to pay for an airline ticket, which are actually about 30% higher than they were last year. Traveling is, if you tried to travel, make travel arrangements, you will be sticker shocked when you try to make an airline reservation how high prices have gotten. Interestingly enough, the plane that I went on to Germany was not completely full, and the plane coming back from Germany, maybe because it was Oktoberfest, but we flew back to Miami, it was partially empty to the point where people were lying down in the middle. I have not seen this in a long time. People were actually stretched out and sleeping in the middle section of the plane because there were so many empty seats. How many people remember being able to get on a plane and be stretched out so that you could sleep and take all five of the middle seats? I don't know if anyone remembers that in a long time, but I was just on that particular flight. So in any event, perhaps things are turning and the market's going to take a rest here, but we don't have empirical evidence. We don't have the evidence to substantiate at this point. I mean, a week and 2 weeks ago, we kind of had a little bit of a stall in the market to take a shot at a short. This week is, I'd love to get short this market. I'd love to say, for the equities, sell against here, but to be truthful, because why do I say that? Because markets fall a lot faster and there's more velocity when everyone's running for the exit door to get short, right? More so than when you get these demand-driven bull markets. Right now, this has been a demand-driven bull market, and it's very strong across the pond. It's strong here still in certain sectors. And so I think if it's anything, it's due for a correction. It might just come in that more of that sector rotational segment. So you take a look at a stock like Home Depot. We had this yellow box down here way long time ago saying, look at the demand in Home Depot. I loved it back down in there. I kind of liked it a little bit here, and I stopped liking it right after it broke out in 2012, and it just kept going. So I think that looking at Home Depot at this point in time, if there's a stock that's slightly maybe overbought, I'm thinking looking at these monthly shadows up in here and this monthly long leg doji in here, and that would be my first clue to start looking at other stocks in home improvement and retailing. Lumber liquidators, we talked about lumber liquidators a long time ago in this room in planning and scanning, and had a nice analysis there. Lumber liquidators is another one. Lowe's, take a look at Lowe's. Lowe's, not anywhere near the performance of a Home Depot, but I think that this parabolic straight up move right here, I mean, that's pretty much straight, is a little stratospheric in the marketplace. So the interesting analysis that I'd like to bring to your attention here as well is that this here, it says spread. Does everyone see this? this spread chart is something that I've created, and basically what it is the relationship of the percentage change on this stock compared to the S&P. See that where it says that, right? S&P. So all I'm doing is comparing that to the S&Ps, and this is a rolling moving average. So basically, what this is saying is that this stock was outperforming the S&P. It was outperforming the S&P. It has been begun since the beginning of September to underperform the S&P. So that tells me right there that guess what? They're starting to come out of this stuff. They're starting to come out of this stuff gradually. So every time you see a price, notice here, and I'm a big, I mean, we really go into in depth on looking at volume behind stock moves. But as this market has moved, and it has moved since this breakout right here, okay, and you all agree that this high is higher than that high, right? We don't have a definitive breakout in volume, and it's underperforming the S&Ps. This is a red flag for the market. So when we take a look at certain stocks and what areas might be victim to new selling, how many people will run out to Lowe's and run out to Home Depot at this point in time and fix their house up? If they've already fixed their house off, you might see a cyclical downturn in that sector. So it might get a little over ahead of itself. So looking at the market from a relative strength perspective to the overall market, looking at the stocks in that sector, you know what? It's definitely one that could be victim to a sell-off coming shortly in that segment of the market. So I just wanted to bring that to your attention. This is what I refer to as that sector rotational element that's been going on in this market that's been confusing a lot of people. I mean, we've been talking about sector rotational correction for a long time. I know we're going to run out of time here, but I think the retail apparel has gotten kind of a bad rap. We've got a nice little move. We've got the retail apparel. Coach is starting to outperform the S&Ps, number one. From a seasonal perspective, we start to see this market start to come into support, and we had big volume coming into the market. So if you take a look at this, the reason I was talking about this is if you look at the breakout and on-balance volume, volume broke out but not with price. So that means they are accumulating long positions in Coach and getting prepared for, maybe they got a product launch no one knows about, maybe they got something going on but insiders know. So I want to focus in on some of these retailer apparel stocks, and I think that's what we're going to see. We're going to see rotation coming out of certain segments of the market. Some of these subsectors, like your home improvements, are going to come down, and perhaps retail apparel, we see an uptick as we get into the holiday season. So this particular week, we've got a lot to look at. I'm going to be very active in the room. We're going to follow up with this stuff. I hope you found some useful information there. Last but not least, let me go over to our day trading page real quick and give you some setups for this morning and this week. And I know Butch has already kind of gone through that. But the first thing we look at, NASDAQ breaking out. This is an hourly charts at the bottom. Hourly charts at the bottom. So the NASDAQ just broke back out into an hourly buy signal, just showing the reflection of that strength in the NASDAQ. You got still weakness in the Dow. And then the Russell here is coming right back up. So for me, watch crude oil price weakness, number one. Watch that break, and it's, for quick day trades, a break under 10, where we are right now, you're kind of getting that break underneath that 10, this 103.5 is going to be some big numbers, all right? So what I would really be careful of, is not selling breakdowns. You want to sell snapbacks. If this thing does have an amazing breakdown under 103, then remember 103 is a magical support resistance area. If it breaks down, look for the snapback and then sell on a signal as the market should return to another low. okay? And then when I say another low, it could get kind of ugly because remember, it's got all that pent-up sideways action for a long time in the marketplace. So with that said, I would definitely look for this area, 103 area first, 103.5. If it acts as support, great, we go back up and test the range. If we break that support and it comes back up and that support now acts as resistance, you guys take some short-term sell signals against it. It's going to be fun, okay? As far as S&Ps are concerned, I think the S&P market, I mean, just simple analysis, Butch probably does this, wouldn't doubt it, but if you take a look at just a simple trend analysis, I think that if you remember this little swing area right in here, look at this, and you take your daily pivots, what are we looking at? You got trend line resistance up here around 1713. You got intraday lows up there that held and acted as support. And so the market, if it gets anywhere near this level and you start getting like 5-minute, 3-minute key reversals, stick with that trend or look for credit call spreads for October on a rally up there. I think we're fairly safe. So that's what I'd be looking at for today, especially since we do have the market in the NASDAQ coming back. It should keep the market, the S&Ps, from falling out of bed immediately. So watch that 713 level. You got a trend line resistance, you got the PIPA number, and you got old levels of support on the charts. That's what we want to be focusing in on today. Watch the retail apparel stocks that I think that's where we're going to see a shift into because the consumer is not all that dead. Ben Bernanke is going to make sure of that because he's going to keep interest rates low. And so that we're going to still see those people with jobs will be spending money, and we'll look for some more scans for some stocks and send out some tweets. That's all I have for this morning. I hope everyone found value in that. Be good. And it's great to be back in the saddle, to be back with our own community of people. Thank you all very much. I mean that sincerely.